Social Security has become an increasingly central component of retirement income for Americans aged 60 to 85 because other sources of retirement funding face mounting pressures. Inflation steadily increases the cost of essential goods and services such as housing, food, healthcare, and insurance, often outpacing adjustments in fixed income streams. While Social Security includes cost of living adjustments tied to official inflation measures, these adjustments do not always match individual spending patterns, particularly for retirees who spend a higher proportion of income on healthcare, which historically rises faster than general inflation. As a result, the real purchasing power of Social Security benefits can erode over time, making it a critical factor in maintaining financial stability throughout retirement. Interest rates also affect the financial environment in which retirees rely on Social Security. Low interest rates over the past decade reduced the income generated by traditional savings vehicles such as certificates of deposit, money market accounts, and bonds. Retirees who cannot earn sufficient interest from their savings often depend more heavily on fixed Social Security payments to cover day-to-day expenses. When interest rates rise, the value of bond portfolios may decline, creating additional volatility that increases reliance on Social Security as a stable income source. Even moderate fluctuations in returns can have outsized effects for those who must supplement Social Security with investment income to maintain their lifestyle. Government debt and fiscal pressures further underscore the importance of maximizing Social Security benefits. With federal debt exceeding $34 trillion, there is increasing scrutiny on entitlement programs, and Social Security is funded primarily through current payroll taxes and trust fund reserves. While benefits are projected to continue being paid under current law, long-term fiscal pressures highlight the value of understanding the benefits already earned. Retirees cannot rely on hypothetical future expansions or enhancements. Instead, they must focus on protecting and optimizing what is already guaranteed to them based on their earnings history and eligibility. Currency devaluation compounds the issue of purchasing power. Over decades, gradual increases in the money supply and inflation reduce the real value of fixed payments. Social Security adjustments attempt to compensate for this effect, but the adjustments lag behind actual cost increases for many essential expenses. Retirees who depend primarily on fixed income outside of Social Security may experience sharper declines in real purchasing power, reinforcing the system's role as the primary stable income stream. Retirement and post-retirement risks, including longevity and health costs, make the reliability of Social Security especially important. Many retirees underestimate how long they will live or how much healthcare and insurance will cost over time. Without sufficient private savings or pension income, Social Security serves as a base layer of predictable income that cannot be outlived. The combination of inflation, limited interest income, fiscal pressures, and currency effects makes the effective use of Social Security essential for maintaining financial stability in retirement. Maximizing benefits through careful timing and coordination with other income sources ensures that Social Security continues to serve as the foundation of post-retirement financial security rather than a shrinking supplement vulnerable to broader economic pressures. Claiming Social Security benefits before reaching full retirement age results in permanent reductions that have long-term consequences for both income and purchasing power. Full retirement age varies depending on birth year, but for most baby boomers it falls between 66 and 67, benefits claimed at age 62. The earliest possible age are reduced by roughly 25 to 30% compared with the amount that would be received at full retirement age. This reduction is not temporary. It is applied for the remainder of the beneficiary's life, which means that the earlier the claim, the more total income is permanently lost over a long retirement. For someone with a full retirement age benefit of $2,000 per month, claiming at 62 would reduce that payment to approximately $1,500 per month, creating a substantial cumulative loss over decades. Early claiming also interacts with inflation in a way that magnifies its effect. Social Security benefits are adjusted annually for cost of living increases, but these adjustments are calculated based on the reduced base benefit if claimed early. This means that inflation protection is applied to a permanently lower payment. Over a 20 to 30-year retirement, the cumulative effect of claiming early and adjusting for inflation can significantly erode financial security, especially when healthcare and living costs rise faster than average inflation. Another consideration is how early claiming interacts with other sources of retirement income. Retirees often rely on a combination of Social Security, retirement accounts, pensions, and savings. Claiming early reduces the monthly Social Security payment, potentially increasing withdrawals from tax-deferred accounts such as IRAs and 401(k)s to meet spending needs. These additional withdrawals can push retirees into higher income tax brackets and increase Medicare premiums under IRMAA rules, compounding the cost of claiming early. Common advice that emphasizes taking benefits as soon as possible often fails to account for household considerations. In married households, claiming early can permanently reduce spousal benefits, survivor benefits, or both. A lower-earning spouse may be entitled to up to 50% of the higher-earning spouse's full retirement age benefit. But if the higher earner claims early, this calculation is based on a reduced payment. The survivor's future income may also be permanently lower, affecting long-term household financial stability. Health and longevity factors further complicate the decision. While early claiming may seem advantageous for those concerned about outliving savings, life expectancy is difficult to predict. Many retirees live well into their 80s and 90s. Claiming early guarantees a lower benefit for potentially 20 or more years, which may outweigh the short-term advantage of accessing payments sooner. The actuarial adjustments built into the Social Security system are designed to equalize lifetime income on average, but individual circumstances can make early claiming a costly choice. The key principle is that Social Security claiming age is a powerful lever with long-lasting consequences. Unlike withdrawals from personal savings or investment accounts, which can be adjusted year to year, the reduction from early claiming is permanent. Once benefits are claimed, they cannot be reversed or recalculated. Understanding the full implications of early claiming, including tax, inflation, and household effects, is essential for preserving both lifetime income and purchasing power throughout retirement. Early claiming is not inherently wrong, but it is the single most common source of permanent benefit loss, and careful analysis is required to avoid unintended long-term reductions in Social Security income. Much of the standard advice regarding Social Security claiming fails because it oversimplifies a complex system and ignores the interaction between benefits, taxes, and household income. Recommendations such as claim as soon as possible or always wait until 70 are often presented without context. Yet the impact of claiming age, earnings history, spousal benefits, and tax coordination can be substantial. Early claiming permanently reduces monthly benefits, but claiming too late without considering other income sources or tax implications can also reduce effective lifetime income. Many retirees follow generalized guidance without understanding how individual circumstances affect outcomes, which can lead to decisions that are costly over decades. One common piece of advice is to take Social Security at the earliest eligible age of 62. While this provides immediate income, it reduces monthly payments by 25 to 30% compared with full retirement age benefits. These reductions are permanent and affect all future cost of living adjustments. Many retirees do not recognize that this choice also influences spousal and survivor benefits, potentially reducing household income in later years. Ignoring these factors can significantly shrink the amount of money available over a long retirement. On the other end, another widely cited rule is to delay claiming until age 70 to maximize monthly payments through delayed retirement credits. While delayed credits increase benefits by approximately 8% per year beyond full retirement age, this strategy assumes that the retiree can afford to defer income, will live long enough to benefit from higher payments, and will not incur higher taxes from other income sources. Without accounting for these factors, blindly waiting can create cash flow challenges or unnecessarily high taxation, particularly if withdrawals from tax-deferred accounts are needed to cover expenses. Many retirees also fail to consider the taxation of benefits. Social Security benefits may be subject to federal income tax, ranging from 0 to 85%, depending on total household income. High withdrawals from retirement accounts, pensions, or other taxable sources can push a retiree into higher tax brackets, reducing the net benefit of Social Security. Common advice often focuses on the gross monthly benefit without examining the effective after-tax income, which is what ultimately matters for financial stability. Spousal and survivor benefits are another area frequently overlooked. Lower-earning spouses may qualify for up to 50% of the higher-earning spouse's full retirement age benefit. Survivor benefits may allow a widow or widower to receive up to the deceased spouse's full benefit. The timing of claims between spouses has a direct effect on lifetime household income, yet generic advice rarely addresses coordination. Misaligned claiming strategies between spouses can result in permanently lower combined income, even if each individual's benefit appears optimized in isolation. Sequence of income risk and longevity also challenge simplistic advice. Many retirees underestimate the length of retirement and the cumulative effects of claiming too early or mismanaging other income sources. Financial decisions must consider a multi-decade horizon. A rigid rule that ignores variability in lifespan, inflation, and taxation can lead to long-term reductions in real purchasing power and limit the financial flexibility needed to respond to unexpected expenses or policy changes. The central issue is that claiming decisions are not one-size-fits-all. Effective planning requires an understanding of how benefits, taxes, spousal entitlements, and withdrawal strategies interact. Common advice often fails because it ignores these interdependencies, leaving retirees vulnerable to avoidable losses. In reality, careful coordination and analysis of all factors determine whether Social Security maximizes lifetime and household income rather than simply following a simple formula. Increasing Social Security benefits over a lifetime requires a strategic approach that combines earnings history, claiming age, and household coordination rather than relying on simple rules or luck. One of the most important factors is the earnings record used to calculate benefits. Social Security uses the highest 35 years of inflation-adjusted earnings to determine the primary insurance amount. Years with low or no earnings reduce the average and therefore the monthly benefit. Continuing to work, even part-time, can replace lower earning years with higher earnings, improving the calculation. For example, a person with several years of earnings below the Social Security taxable maximum may increase benefits by contributing higher income years late in their career, which directly raises the computed benefit amount. Claiming age is another key lever. Benefits claimed before full retirement age are permanently reduced, while benefits claimed after full retirement age accrue delayed retirement credits at approximately 8% per year up to age 70. The optimal claiming age is therefore highly dependent on individual circumstances, including life expectancy, other income sources, and household needs. Coordinating the claiming strategy between spouses is equally important. A lower earning spouse may qualify for up to 50% of the higher earner as full retirement age benefit. Choosing when each spouse claims affects both monthly income and survivor benefits, which can last for decades. Deliberate coordination can maximize combined household benefits over the long term rather than optimizing for one individual in isolation. Tax coordination is an additional consideration. Social Security benefits are taxed based on combined income, including withdrawals from tax-deferred retirement accounts, pensions, and other taxable sources. A higher income can cause up to 85% of Social Security to be taxable, reducing net benefit. By carefully planning withdrawals from IRAs, 401(k)s, and other accounts, retirees can control the amount of Social Security that is taxed in any given year. Timing distributions to coincide with lower income years preserves more after-tax benefit, effectively increasing the value of Social Security without changing the gross payment. Delayed claiming and strategic earnings adjustments also provide protection against longevity risk. Many retirees underestimate how long they will live, and Social Security is designed to provide lifetime income. By maximizing the base benefit through high earning years, delayed claiming, and spousal coordination, retirees can secure a higher stable monthly payment that continues regardless of how long they live. This approach mitigates the risk of outliving other retirement assets, which may be drawn down during market downturns or inflationary periods. This system-oriented strategy works across decades because it relies on structural principles built into Social Security rather than predictions about interest rates, market returns, or policy changes. It focuses on factors within the retiree's control, improving earnings history, selecting the optimal claiming age, coordinating with spouses, and managing taxes. Each of these elements interacts with the others, and small adjustments in one area can compound over time to produce meaningful increases in lifetime benefits. In practice, this means retirees can increase both individual and household Social Security income by actively managing these levers. They do not need to rely on speculation or market timing. By carefully planning earnings, claiming, and tax coordination, they preserve purchasing power, reduce the effect of inflation, and maximize the predictable, stable portion of retirement income. This structured approach ensures that Social Security serves as a durable foundation of financial security throughout retirement and into advanced age. Maximizing Social Security benefits over a long retirement requires a stability-focused framework rather than reliance on one-time tricks or predictions. Many retirees make the mistake of focusing solely on short-term gains or single decisions, such as claiming early or late, without considering the cumulative effects on lifetime and household income. A durable approach prioritizes principles that are predictable and under the retiree's control, including earnings history, claiming age, spousal coordination, and tax management. This method reduces the risk of irreversible mistakes that permanently lower benefits or create cash flow problems. One central principle is protecting the base benefit. Claiming before full retirement age permanently reduces the monthly amount, which then affects future cost of living adjustments. Even small early reductions compound over decades, eroding total lifetime income. Delayed retirement credits, by contrast, increase benefits predictably for each year claiming is postponed after full retirement age up to age 70. Understanding these fixed, actuarial adjustments allows retirees to make decisions that maximize benefits without relying on external factors, such as market performance or legislative changes. Another principle is coordinating Social Security with other retirement income. Benefits are taxable based on combined income, including withdrawals from IRS, 401, CALS, pensions, and other taxable accounts. Careless timing of these withdrawals can push retirees into higher income brackets, causing up to 85% of Social Security to be taxed. Planning withdrawals strategically can reduce the effective tax burden, increasing net income without changing the gross benefit. This requires evaluating the interactions among all income sources and adjusting distributions accordingly, a principle that is effective in any economic or policy environment. Household coordination is equally important for married couples. Spousal benefits can provide up to 50% of the higher earner's full retirement age benefit, and survivor benefits may allow one spouse to receive the deceased spouse's full or delayed benefit. Claiming strategies that do not account for both spouses can permanently reduce household income, even if each individual's benefit appears optimized in isolation. Coordinated decisions maximize total household benefits over the long term, which is particularly relevant given the increased longevity of retirees and the potential for decades of surviving spouse income needs. Longevity planning is another enduring factor. Many retirees underestimate how long they will live, and Social Security is designed to provide lifetime income. A stability-focused framework ensures that benefits are optimized for the expected duration of retirement, protecting against the risk of outliving other savings. By relying on factors within the retiree's control, such as earnings history and claiming age, the framework does not depend on predicting interest rates, inflation, or future policy changes which are inherently uncertain. This framework is durable because it is structured, principle-driven, and repeatable. It emphasizes protection of the base benefit, strategic integration with other income, household coordination, and consideration of longevity. Small adjustments in any of these areas can compound to materially increase lifetime and household Social Security income. The focus is on predictable, sustainable strategies rather than speculation or one-off tricks, ensuring that benefits remain a reliable foundation of retirement security over decades. By systematically applying these principles, retirees can increase their net income, preserve purchasing power, and reduce risk across all phases of retirement, achieving long-term stability. Money held by retirees is under steady pressure. Inflation has raised the cost of housing, food, insurance, and healthcare. Interest rates have moved sharply, affecting savings income and market values. Government debt has increased, and the purchasing power of the dollar has declined over time. For people aged 60 to 85, Social Security is no longer just a supplement. For many households, it is the most stable income source left, and its real value matters more each year. The problem is that Social Security was never designed to grow faster than inflation. Cost of living adjustments are tied to official inflation measures, not to individual spending patterns. Healthcare and insurance costs, which rise faster than average inflation, consume a larger share of retiree budgets. This means that even when benefits increase, purchasing power often does not fully keep up. At the same time, other retirement income sources may discover lower real returns or higher taxes, increasing dependence on Social Security. Social Security also faces structural pressure. Benefits are paid from current payroll taxes and trust fund reserves. As more retirees draw benefits and fewer workers contribute per beneficiary, the system relies increasingly on policy adjustments. While benefits continue to be paid under current law, long-term funding pressure increases the importance of maximizing benefits that are already earned. Common advice often fails because it oversimplifies the system. One frequent suggestion is to take benefits as soon as possible. While this may be appropriate in limited cases, claiming early permanently reduces monthly benefits. For someone whose full retirement age benefit is $2,000 per month, claiming at 62 can reduce payments by roughly 25 to 30% for life. Over a long retirement, this reduction compounds into a significant loss of total income. Another common recommendation is to wait until 70 no matter what. While delayed retirement credits increase benefits by about 8% per year beyond full retirement age, this advice ignores individual factors such as health, other income sources, taxation, and spousal coordination. Blindly delaying without understanding cash flow and tax effects can create strain or missed opportunities. Some advice focuses only on the monthly benefit amount and ignores taxes. Social Security benefits can be taxed, reveal up to 85% depending on total income. Poor coordination with other retirement withdrawals can reduce net benefits even if gross payments are higher. What actually works is understanding how benefits are calculated and coordinating claiming decisions with the rest of retirement income. Social Security benefits are based on the highest 35 years of inflation-adjusted earnings. Years with zero or low earnings reduce the average. Continuing to work, even part-time, can replace lower earning years and increase the benefit calculation. Claiming age is the most powerful lever. Claiming before full retirement age results in a permanent reduction. Claiming after full retirement age results in permanent increases through delayed retirement credits until age 70. These adjustments are actuarial and predictable, not speculative. Spousal and survivor benefits are another overlooked area. A lower earning spouse may be eligible for up to 50% of the higher earner as full retirement age benefit. Survivor benefits can be as high as the deceased spouse's full benefit or delayed benefit amount. Coordinating claiming ages between spouses can materially increase lifetime household income. Tax coordination also matters. Managing withdrawals from retirement accounts to control taxable income can reduce how much of Social Security is taxed. This does not increase the gross benefit, but it increases what is actually kept and spent. A practical discovered framework focuses on stability rather than optimization. The goal is not to guess life expectancy or future policy, but to reduce irreversible mistakes. Once claimed, benefit reductions or increases are largely permanent. Decisions should be made with a long-term view. The framework rests on three principles. First, protect the base benefit by avoiding unnecessary early reductions. Second, coordinate Social Security with other income sources to manage taxes and cash flow. Third, account for household benefits, not just individual payments, especially for married or widowed individuals. A step-by-step checklist follows. Obtain an accurate Social Security statement and confirm earnings history. Identify full retirement age and estimated benefits at 62, full retirement age, and 70. Evaluate whether additional work years could replace low-earning years. Analyze spousal and survivor benefit eligibility and coordination. Review how other retirement income affects Social Security taxation. Choose a claiming age that balances lifetime income, tax exposure, and household stability. Revisit the decision before claiming, as circumstances and rules may change. Educational disclaimer: this material is provided for general educational purposes only and does not constitute financial, tax, or legal advice. Individual circumstances vary, and decisions should be evaluated based on personal financial conditions and current law.